Hey, how's it going, everybody? This is Theta Warrior. In this video, we're going to be discussing the options Greeks. We're going to go over the basics, we're going to go over some tips, and we're going to go over some really important things that I think a lot of people miss and probably leads to the reason why a lot of beginners actually lose money trying to trade options is because they don't understand how the Greeks move. They don't understand why their position does what it does. So I'm going to go over everything you need to know. And at the end of this video, you're going to have a much better understanding of the options Greeks. And a little later on, we'll actually pull up an options chain and I'll show you how you can add the Greeks and so you can watch them live during the day while you're trading. So we're going to cover delta, gamma, theta, vega, and rho. So first, let's start with what are the Greeks. So the Greeks are a set of mathematical outputs generated by an options pricing model that help describe the options price and its expected change based on the underlying itself. So by knowing this information and having an understanding of the Greeks, you're going to be much better off to protect yourself and to be a much better risk manager. Because if your position is losing value and you don't understand why, that's only going to hurt you. And so understanding how these Greeks will change your price of the option, the value of the option, is going to help you exponentially. Okay, so just real quick, delta will cover the price sensitivity. Gamma will cover delta's rate of change. Theta is our time decay Greek. Vega is our volatility sensitivity Greek, and rho is our interest rate sensitivity Greek. So the main four that you're going to want to know and watch pretty closely are going to be delta, gamma, theta, and vega. Rho is important as well, but it has much less of an effect on the option price itself. I'll get into that a little bit later on. So first off, let's start with delta. Delta is the expected change in an options price for every $1 move in the underlying stock. So a really basic example would be for calls, let's say. Let's say you have a call with a delta of 50. If the underlying price goes up by $1, your option should increase by 50 cents. If you have a call and the delta is 75, and the underlying goes up by $1, you can expect your option to increase by 75 cents. Okay. If you have a put with a negative delta of 0.25, for example, and the underlying drops $1, you can expect your option to go up in value by 25 cents. The option will change by 25 cents. Okay. Puts will always have a negative delta, a range from -1 to 0. And call options will always have a positive delta from 0 to +1. They can range anywhere in between these, but a call can never have negative delta and a put can never have positive delta. Okay. So just a really easy example, an out of the money option is going to have a much lower delta. Okay. The out of the money options have a 5 delta, a 10 delta. That's why they need such a drastic move to actually be profitable. So most traders avoid super far out of the money contracts because you need a huge move in the underlying to actually make money. So the at the money strike for the call is a +50 and the at the money strike for a put is a -50. As contracts go deeper and deeper into the money, their delta will increase. So for example, a call with a delta of 10 that starts to move closer and closer to the money will go up in delta until finally it goes as deep in the money as possible, and then it becomes a 1 delta. Same is true for puts. The out of the money will have a very low delta. The at the money will have a 50 delta, and the in the money will have up to a 1 delta. Another really helpful tip for thinking of delta is it's the probability that an option will go in the money. So if you have a delta of 10, there is only a 10% chance that that option will expire in the money. A 50 delta has exactly a 50-50 chance of expiring in the money and out of the money. So remember that the next time you go to buy some crazy out of the money 5 delta option that we both know now only has a 5% chance of moving into the money. So here we can see exactly what I'm talking about. Puts with the negative delta, calls with a positive delta. Calls will go from 0 to 1 as the stock moves through the strike. Puts will fall from 0 to -1 as the stock drops through its strike. In this example, the 3 is our strike. At 3, the put has a -50 delta. At 3, the call has a positive 50 delta. As price goes deeper and deeper into the money, the call delta increases. Now moving on to gamma. Gamma is the expected change in delta for every $1 move in the underlying. Gamma literally just measures the rate of change of delta. Now, gamma is a really important one, especially for those of you that like to trade weeklies and zero DTE options. That actually is the reason why the option is so volatile, and I'll get into that in just a minute. So in this example right here, let's say our delta is a 50 on our call, okay? And our gamma is a 0.05. If the stock raises $1, we have a new delta of 0.55. If our gamma is, let's say, 0.2, and the stock goes up by $1 for our call, the delta now will be 0.7. So gamma literally just measures the rate of change of delta. Gamma is always going to be positive for calls and puts. It is highest when an option is at the money. That's really important to note, okay? Because let's say you buy something super far out of the money. Again, you're going to have a very small delta and you're going to have a very small gamma. They're just not going to move. Whereas if you buy something much closer to the money or something that is even in the money, you're going to have a higher delta and a much higher gamma, and you're going to get a much better bang for your buck. So the option is actually going to move a lot faster the closer to the money you buy something, simply based on the fact that the gamma is the highest for the at the money strike. So gamma will actually get lower the further away the underlying moves from the strike, whether that be in the money or out of the money. Again, you can kind of think of gamma like a bell curve. It's going to be highest at the money, and it goes down as it goes out of the money, and down as well as it goes in the money. Now, this is really key, like I said, for all of you zero DTE options traders. Gamma will rise sharply as expiration approaches. This is the source of the gamma risk near expiry. So, for example, we all know, zero DTE options, they're absolutely insane, right? They can move so quickly. They're so volatile. It's actually not the delta. The delta is going to be pretty much consistent roughly. It's obviously going to change a little bit from expiration to expiration, but the at the money is usually always going to be a 50 delta, right? The gamma, however, will continue to go up and up and up as you get closer to expiration. The gamma will increase. So when you actually trading the weeklies or you're trading the zero DTEs, the gamma is going to be extremely high, which impacts delta so much. That's why the option is so volatile, because the gamma itself has such a massive effect on delta. So keeping this stuff in mind can be really helpful the next time you're trying to select an expiration. All right, moving on to theta. Theta is the expected decline in an option's extrinsic value with each day that passes. So what is extrinsic value? Extrinsic value is just the amount of premium that is in the contract. So really simple example, if you have the 5 call, okay, and the stock is trading at $7, you're $2 in the money, right? The option, let's say, is worth $2.50, okay? That means there's 50 cents of extrinsic value in that option that still needs to decay and will decay by expiration. Now, the premium is going to be greater and greater as you go further out in time. Extrinsic value decreases at a quicker and quicker rate as you get closer to expiration. It is always going to be negative for long options, and it's going to be highest at the money. So again, it works just like gamma. You can visualize it as a bell curve. The theta will be the highest at the money, and it will go down or it will decrease as you go further out of the money or further into the money. Theta really increases as you get closer to expiration, but when you hit that 55-day mark, that's when really the theta decay will start to increase. And every day closer to expiration, it goes up and up and up. So if you have a theta of 50, for example, your option is expected to lose 50 cents in value every single day. That's why it's commonly said that theta is the friend of the option seller and the enemy of the option buyer. So as a theta warrior, you need to be extremely aware of theta, because if you're long theta, you are always going to be in a losing position unless you have delta, gamma, and Vega outpace the loss of theta. That's the only way you're going to make money when you're long options. If you're an option seller, you want time to go by. You want this to lose money. So if you're a trader like myself, sometimes it's very helpful to be long theta. Sometimes it's very helpful to be short theta. It really just depends on the situation, but having an understanding of what theta is and how it works is going to help you put on the right trade for the right situation. So here's a great graph that shows exactly the rate of decline of theta. Okay, you can see that it is an exponential decline. So here we are out 120 days. Theta is moving pretty slowly. Okay, it's still eroding our position. You can think of this is the extrinsic value here that we're looking at, okay? So from 120 days to 90 days, theta has the least impact. From 90 to 60, it gets slightly greater. From 60 to 30, it's still getting greater. And the final 30 days are going to be the most rapid decline until it eventually hits zero. So you can see right around here, 55 days out, it really starts to kind of pick up, really especially within 30 days. Typically, if I'm going to be an options seller, personally, I don't really like to go out beyond 30 days. I mean, even less is better because that's really going to get a good bang for your buck if you're short premium. Now, if you're looking to be more of a swing trader or you want to have a little bit more time on your side, going out 60, 90, 100 days, whatever you're comfortable with, a few months to really combat the rate of theta, you can see that it's going to move against you at such a slower rate. All right, moving on to Vega. Vega is the expected change in an options price for every 1 percentage point move in the implied volatility. Okay, so for example, if we have a 0.15 Vega, an implied volatility goes up by 1 point. The option will gain 15 cents in value with no move to the stock at all. That's a really important point to note, with no move to the stock at all. And I'll give you a great example right here. Have you ever been in a position, let's say you're in a call position and the stock goes up and you don't make money? Okay, what happened? Well, either theta got you or the Vega decreased. Implied volatility went down. If you're in an options contract and the stock moves in your direction and implied volatility goes down, you're not going to make money. Now, conversely, maybe you've been in the position where you're in calls and the stock is moving against you and you don't lose money, or you lose money at a much slower rate than you would have expected. That is because the Vega, or the implied volatility, is going up. So Vega can both hurt you and help you depending on the situation. If you're long premium, meaning you've bought an option, okay? You want Vega to increase. You want volatility to go up. That's why puts can pay so well, because maybe you catch a move right before the actual, dive in the stock. When the Vega is low, you buy your contracts at a low volatility. Then the stock actually dumps. You actually get the move right. Vega could go through the roof. You're going to make money on the change in delta. You're going to make money on the change in gamma, and you're going to make money on the Vega increase. So you have three things moving in your direction. So implied volatility is the friend of the option buyer going up, and implied volatility is the friend of the option seller going down. An option seller is going to want to sell options with a very high volatility, because let's say you sell something with a volatility of 100. I'm just using implied volatility as an example. The implied volatility is 100. You sold the option. The option doesn't move, okay? The underlying doesn't move, but the implied volatility goes down to 50%. You're going to make money. The option seller will make money, okay? Now, conversely, if you bought an option, let's say you've bought some crazy meme stock with an implied volatility of 300%. Now, the option is just sitting flat. It starts to consolidate. You're going to lose money so fast, it's going to make your head spin, because the implied volatility is going to drop like a rock. Okay, so you have to be really aware of what the implied volatility is doing, or what the Vega is, before you buy or sell an option. Remember, long options, you want to buy low volatility. Short options, you want to sell high volatility. Vega is always positive. A rising IV will help an option's value and hurt it if it starts falling. It affects calls and puts equally at the same price. It's highest at the money with more time to expiration. Long-dated options carry the most volatility risk. All right, moving on to our last Greek, rho. Rho is the expected change in an option's price for every 1 percentage point move in interest rates. Calls have a positive rho, with rising rates modestly increasing call values. Puts have a negative rho, with rising rates modestly decreasing put values. Rho will most often affect leaps. And like I said, it's probably the smallest and most overlooked Greek in day trading because it has the least amount of effect. All right, let's do a quick recap. Delta. It measures a $1 move in the stock. It's positive for calls, negative for puts. It peaks when the contracts go deep in the money. And a simple way to think about it is the probability of a contract finishing in the money. Gamma measures the delta's rate of change. It's always going to be positive. It's highest at the money, and the fastest delta shift will happen at the money. Theta will measure the rate of decay over time using intervals of 1 day. It is always going to be negative. It is highest at the money and near expiration. It's on the side of the seller and against the buyer. Vega measures a 1-point move in the implied volatility, always going to be positive, highest at the money and for longer expirations, and it will spike when there's a catalyst on the horizon, such as a Fed announcement, an earnings report, anything like that that's an unknown that the market is expecting a big move for. That's when Vega will spike the most. And finally, Rho measures a 1-point move in interest rates, is positive for calls and negative for puts, peaks for long-dated expiration contracts, and overall it has a very small impact on the price change of options. So how to put the Greeks to work? You'll want to use delta to gauge the directional exposure and rough odds of a contract finishing in the money when choosing which strike to trade. Watch theta and gamma together inside 30 to 45 days to expiration because decay and price sensitivity both intensify as expiration nears. High Vega positions benefit from IV expansion. Consider trimming exposure into known catalysts like earnings. And a great way to hedge your portfolio is combining all of these Greeks across positions to see net direction, such as your delta, your acceleration, also known as gamma, your time decay, known as theta, risk at a single glance. All right, now we're looking at an actual options chain. We're looking at the NVIDIA options chain. I just want to go over and show you a few really easy things that you can do at home. So we've got delta, gamma, theta, and Vega. Like I said, those are the main 4 that you want to watch. We've got calls on the left, puts on the right. You can see here, call delta will increase as they go further in the money, right? And decrease as price goes out of the money. Opposite happens for puts, or I guess the same happens for puts, but in the opposite direction. Delta will increase as puts go deeper and deeper into the money. So let's open up a few other expirations just to show you exactly what I mean. We'll go some really outdated stuff. So these contracts expire in 2 days. You can see the Vega 0.6 on this example here. The Vega will go up and up and up. Okay, so the further you go out, the higher the Vega will be. For theta, it's going to be highest at the closest expiration. You can see it goes down as we go further away. So Vega and theta have an inverse relationship in regards to time. Gamma will go up as you get closer to the expiration. You can see it's a 0.06 here, 0.4 here, 0.02 here, and basically has no effect on these 316-day out expirations. You can see for the most part, delta is going to be a 50 at the money for either calls or puts, except for when you go further out in time. That's when it starts to shift a little bit. So again, if you're looking to sell options, you want to use those with a higher theta. If you're a 0 DTE trader, be wary that the gamma will increase as you go closer in time. If you want more time to be right and have less of a theta effect, go further out in expiration. And there you have it, some real world examples of how the Greeks impact your options pricing. So a final recap, delta tells you how much and in which direction your position moves with the stock. Gamma tells you how fast that expiration can change, especially near the money. Theta tells you what time is costing you or paying you every single day. Vega tells you how sensitive your trade is to shifts in market volatility. Rho rounds out the picture for longer dated positions and shifting rate environments. If you like this video, feel free to visit our website, thetawarriorpro.com/education. I've got a ton of write-ups. Understanding the Greeks is just one of them. I hope you found this video educational, fun, learned something new. If you did, let me know in the comments below. This was something that I found really interesting when I first started trading because I wanted to better understand why an option would move, like why I was making money, why I was losing money. So I dug in and I really had a quick understanding of the Greeks, and it helped me a lot. It really helped me become the trader that I am today. It gave me a much better understanding of what's actually happening below the surface. So again, if you like this, like, comment, subscribe, do all that stuff. Really appreciate you. We'll see you in the next one.